I'm David Bank, and from Impact Alpha, this is an Agents of Impact podcast.
Our goal is to say, if it was 6x financial return, can we do more during that 5-year holding period to make it a 12x impact return by having a deeper impact on, for example, low-income beneficiaries or having a more substantial supply chain impact with our climate commitment?
That's Dave Kirkpatrick, Managing Director and co-founder of SJF Ventures, a climate and impact investor in Durham, North Carolina. Along with SJF's Director of Impact, Kelsey Jarrett, Dave joined me to talk about finding the alpha in impact. Their new guest post marking SJF's 25th anniversary details what's next in impact measurement and management, or IMM. Find it on impactalpha.com. Let's jump right in. Kelsey and Dave, welcome to the podcast.
Thanks for having us.
Thanks for having us here.
Dave, is particular. You've been at this quite a while. Congratulations, 25 years from what I think was originally the Sustainable Jobs Fund.
That's right. Time flies. Yeah, we're having fun.
And the field has evolved. So we want to drop back to some of the evolution, but I actually want to get your kind of trend spotting take on where things are going. I mean, there's a lot more interest in the kind of investing SJF is doing. So just tell us what you're excited about.
Yeah, no, I think we're thrilled with how much company we have now. So we helped to launch Impact Capital Managers with some of the other early impact funds, and now we've seen, whether it be Bain or KKR or Apollo, there is a recognition that you can drive great financial returns with high impact companies, and so that is very different from when we started 25 years ago. And I think even in sustainability to clean tech to climate tech, there is a burgeoning of uses of private capital to drive environmental and social goods.
You mentioned Impact Capital Managers, and I know you were involved in the founding of that, and they've put out a couple reports describing and sort of articulating the alpha in impact, which of course Impact Alpha is keen on as well. And it really is the kind of folks that are not just saying, I think folks used to say, chasing market rate returns. And I think that became apparent that maybe market rate wasn't exactly what you're looking for. It's actually alpha. It's actually some differentiation or extra, right?
That's right. Yeah, in the early work I remember the session where we had some of the early funds gathered, and we did the sort of 10 drivers of how you generate alpha in sort of finding deals, aligning with entrepreneurs, adding value while you're an investor in the company and on the board, and then having an aligned exit, a premium exit, because of the kind of societal environmental value that's baked into the DNA of the company. So it's still, I mean, we have to prove that out, and every day we're working with our companies and our peers across the industry and it's not easy. Venture capital is not easy, and impact venture capital is not easy. But I think we articulated how it can work, how you can drive unique financial value that is driven by and integral with the impact of the companies.
Now you've at least in climate, and maybe less so in sort of some of the more social sectors, although as you said, there's been movement there as well. But at least in climate, you've got company now from the I was going to say big boys, and it mostly is boys, but the big guys in venture, at least in climate tech. You're seeing folks move in your direction.
Yes. I mean, sometimes I say better late than never. I mean, it's we have such tremendous climate challenges are self-evident, this summer and all the time. And so I think there is substantial private capital moving. It is, as a fiduciary for us, it makes it a bit harder because there is more competition for deals, but that's a good thing. And because also there's capital for the next stage, the Series B, C, and the growth rounds, as well as and seed funds as well. So yeah, no, there's more out there. There's more recognition that you. I think there's recognition the climate challenge is sort of self-evident, right, at this point, in a way that it wasn't 20 years ago.
Which also presents the opportunity for the solutions as you say. Kelsey, let's bring you in because you've just joined up, I think, fairly recently as the director of impact, and I know SJF, has been at the forefront along with the kind of market rate or alpha thesis, but also in actually measuring impact and measuring it across a bunch of parameters. So just tell us, why it actually makes makes a difference, or makes a, provides an advantage to actually know what kind of impact you're having.
Yeah, I mean, well, there's a number of reasons. I think you can't manage what you don't measure. And so making sure that our companies are tracking, you know, the key indicators that are going to make a difference for their customers at the end of the day and the lived experience of their customers, how they're actually using these products and how it's affecting their lives on the social impact and, the measurable impact on our environment on the climate side. I think it's important to help them track what's actually actionable. And so SJF's whole impact measurement program is designed around helping them think through what those key metrics are. And that may evolve for a lot of our companies since they are in an early stage. What they measure when we first invest might not be what they measure 10 years down the line.
Absolutely. But and everybody I think would agree on the general proposition about managing what you measure, and or measuring what you want to manage. But actually putting that into practice turns out to be sort of devilishly complex. And how do you get the data, and how do you report it, and who pays for all that, and how much is it a burden versus a strategic advantage? So how do you get around all those nitty-gritty problems?
I think it's tough because not only do we have multiple stakeholders that we are reporting, SJF's impact towards, and some of that is data that we collect from portfolio companies, and each company has multiple investors, some of them multiple impact investors that they're reporting data to. And so my goal and how we work with them as partners is to, you know, make it as collaborative as possible. So we have our UpMetrics dashboards. We actually share that information. They're back with the companies. So what they give to us, they can see their year over year data. They can see it benchmarked against their portfolio. And I was about to say every year, I've only been here for one reporting cycle, but looking into our next reporting cycle as well, we'll reevaluate what we're asking them. And if there's data that we're not getting good feedback from companies on, maybe that's not a metric we want to collect. Maybe it's not useful to them. And that's sort of the feedback that I want to continue to get from companies so that this is not a burdensome process or any more burdensome than it needs to be, that it's actually something that they get value out of at the end of the day.
Now you mentioned up metrics, and just again, into the weeds here. That's a platform I know that companies can use to report their impact data across various parameters, obviously, and then it helps roll it up into an impact report. And I imagine if you rolled all the portfolio companies, then you would then understand something about SJF's impact. So tell us how that works. Like you pay the freight, right? You don't make the portfolio companies have to pay for their own reporting platform, right?
No, that's correct. And then we give them access to their dashboards so that they can, in theory, share that with whoever they needed to sort of report their impact on as well.
And do the portfolio companies find that's useful then to have their own dashboard and to be able to track? I mean, they might have kept things in scraps of paper, or spreadsheets or what have you, but to have it all sort of organized and benchmarked, does that turn out to be helpful to the companies?
We hope so. We actually just relaunched their company dashboards this past week and have shared it back to them. So this is an ongoing conversation with our companies. Hopefully, now that they have access to these benchmarks, we've reorganized the data, that it can continue to be a useful tool to them.
And so we're talking about things like what, like tons of carbon averted, or quality jobs created. Like sometimes it's across the E and the S, right? That companies will report. I think you were calling out Posigen, for example.
Right. So a lot of our companies sit across sort of both the social and the environmental, and even within those, they may sit across, health and education, or climate and sustainability. And so the way that we think about SJF's impact and the data that we collect is at the standardized level. We ask questions around quality jobs. How many jobs are they creating? What's the caliber of these jobs? What's the sort of difference between the lowest paid and the highest paid employee? What kind of benefits are they providing? And that's all sort of standardized across the portfolio so that we can measure sort of their impact that we're having on the quality job market. We also ask basic ESG metrics about their governance, about again their human capital practices, their environmental practices, and then on each company we ask maybe three key impact indicators, we call them, and those are tailored to the company because as we invest in such a wide variety of different business models across these six sectors, that we don't ask standardized impact metrics in that way. Each company has their own bespoke metrics.
Dave, so this is interesting. You guys, one of the rare VCs that invests. I mean, there might be climate VCs, but there's not that many climate VCs that also have a quality jobs strategy or a social mission. So how do you sort of see the multiple strategies that you guys are working on at all times, and maybe how do you think across them?
Yeah. I mean, I think just to touch on the prior topic or related is that when we in our early investment memos about a company, the key impact indicators are part of what we're seeking to incorporate in our returns analysis. So it is not only we think in this scenario we get a 6.2x return in 4.5 years, but here's how that impact is aligned. And something we can get to is how can we bend that curve so it's not just collinear, but what extra do we do? But coming to your specific question on the sectors that we're in, I mean, from the beginning, Sustainable Jobs Fund, we had both environmental and social community impact in our DNA. Over the 25 years, it's been part of our culture to say, as younger investment team members and impact team members kind of grow up with us, and we've had retention of our team. Most the tenure of our team is some of us have been together 20 years more. Is basically say, for example, we had a partner who was very passionate about government technology, civic tech, and that was not a theme that we were early on investing in. And he's really built out that portfolio. Similarly, Cody had a passion about health and wellness. She originally was a clean energy investment banker, but learned and focused on that segment, and we built out a meaningful segment. So we pretty much said to our team, listen, if it's high growth, positive impact, basically North American market, and you can make a good case for a venture capital return. Obviously, there are sectors where it's like, yeah, you scratch your head, the regulatory and the environment's not right for a VC return. But as long as it hits those boxes, we've been able to kind of build out the environmental and social impact in a few different themes that are very intersectional, as Kelsey mentioned.
You kind of glanced over a hot button word, collinear, which has been always the sort of holy grail. And obviously, it's kind of a have your cake and eat it too strategy, where the growth of the company also drives the growth of the impact, and everybody likes those kinds of things. But you said, I don't know, beyond collinearity or something, or collinearity plus or something.
Yeah, this came from a whiteboard discussion a few years ago, but one of the things we it was basically, yeah, you draw the collinear, right? 6x financial, 6x impact, and then we say, but okay, we're co-investing with conventional VC funds. In matter of fact, Harvard did a study on impact investing where they're kind of questioning impact investors if they always co-invest with conventional VC. So the question is, what else are we doing, right? And so our goal is to say, if it was 6x financial return, could we do more during that 5 year holding period to make it a 12x impact return by having a deeper impact on, for example, low income beneficiaries, or having a more substantial supply chain impact with our climate company? So we're trying to do, even having a team like Kelsey and Anna and the team we have, is like, what else are we doing beyond just the everyday VC, right? With a because what conventional VCs will invest in collinear impact companies, but they're not focused on how to drive that extra impact, right?
Is there an example, and sort of feeling compelled to find an example of where you actually added some value? With
Yeah, well, I mean, just you mentioned Posigen just this week, right? So the Posigen team was in our New York office, and we did this 60 decibels sort of listening survey for them, for their customers. And Kelsey, you can talk about this, but it's really helping on their impact and on their customer service side, right?
Right. So I think to even go back to one of the things Dave was saying is that we think about the metrics we're going to measure from the sort of early investment diligence stage. We do the same thing with these impact acceleration work. We think through, all right, if we invested, what sort of SJF's additionality here? What could we do during our hold period to help them, with their impact above and beyond maybe what a traditional investor would do? And so that's already from the time of investment something that we're thinking about. With the 60 decibel studies, when I first joined, I was in the theme of looking at our data collection practices and what we're getting from companies and how we could be more collaborative. I really wanted to do a pilot with, I think we're doing 6 studies with 60 decibels, the impact measurement firm. And they do sort of market research for impact measurement.
And just to remind listeners, 60 decibels kind of pioneered a way to collect actual end user beneficiary customer kind of data in a relatively cost effective way. So instead of just relying on the self reported data of the company supplying the service, you get the voice of the folks who are actually using it or buying the service.
Absolutely. And as a disclaimer, I worked for them as well when I lived in the UK, so I had insight into how valuable their product was. No, so when I joined, I wanted to do a pilot with our portfolio companies and do a number of these studies, and Posigen was one of them. And we just got their data back, and it's such an important launch pad for what kind of work we could do. So the data in itself is already sort of an impact acceleration project. SJF can help them sort of reach those customers. But then what we do with that information, I think is step two. So we had a great conversation with the team, and we've got this data back on not only what their cost savings was, which was information they had, but what our customers doing with those savings. And that was really valuable information. And I think one of the things that we learned, without sort of giving too much away about the data here, was beyond sort of the financial benefits, there were broader sort of social benefits. People felt safer, for example, because they had more consistent power sources. And that's, I think, we wouldn't have known that without doing this kind of customer listening exercise. So yeah, I'm really excited about the kind of work we can do with Posigen now that we've gotten this data. Like, what's next?
Terrific. Well, you guys are hitting all the hot button words, and you mentioned additionality, which everybody loves, and which has been brooded about the impact world for many years. And so maybe the ultimate question is: does all the measuring and tracking and reporting of impact that you do contribute to the alpha and impact thesis, and as well as the additionality of your own impact, Dave? Have you proven out the case?
Well, we're always seeking to prove it. I mean, I think, when we look back at some of our historical examples, so Vital Farms, we led the financing in a pasture-raised egg company, right? Most VCs were scratching their heads. You mean you're not doing biotech or gaming? You're doing eggs, right? And so, we were the first institutional investor. It was the first for benefit company to go public on NASDAQ. So it was a massive win for us and shareholders and for the farmers and for more sustainable food production. Another example is Nextracker, single axis tracking, which we led Series B. Long story, sold them to Flax. They raised capital from TPG Rise, which is a much bigger impact fund in the ecosystem, and then just went public when it was the biggest IPO last year. So, we have all those examples where our engagement to say you can build an impactful company that's driving a sector. I mean, who would have thought people would pay this much for eggs, right? So, and to help sustain those family farmers to do it the right way and to have better animal husbandry, for example. So, or before Nextracker, most solar projects were all fixed tilt, to get a bit geeky. But now most utility scale solar globally, and they're the global market leader, has tracking because of the innovation of Nextracker. So those are examples of both moving, sustainable food, moving climate impact in real substantial directions. When other VCs were like, "Yeah, solar's kind of out of favor in Silicon Valley." Here was a North Carolina fund at that time before we had a West Coast office almost. So
All right. Well, last
yeah.
question then. Real last question is: if you were early on those good trends, give us a few tips for the next big trends.
Yeah, I mean, obviously the whole AI theme is huge across multiple companies, and so we have, like, in the GovTech theme, we have Authorium, which is basically helping with government procurement processes, which can be so tremendously inefficient, right? As we try to drive social environmental benefit, and they're using AI and software to help government more efficiently procure goods and services, right, and more provide grants, et cetera. So I think we're seeing, and we're working on an AI related company now in the climate space. So I think using the latest technology to drive deeper impact is sort of a key thing we're working on. We're working on one in climate resilience and adaptation right now. So we'll be publishing a market study on that any day now. So I think, it's how to tap the latest technological trends to drive substantial, impact.
And then measure it and then report it, as Kelsey would remind us. And so thank you to both of you. We'll be watching both for your impact and for your reporting of your impact. And we look forward to having you back again soon.
Great. Thanks for the leadership of Impact Alpha and the great work you guys do.
That's going to do it for this Agents of Impact podcast. Thanks to Dave and Kelsey. Dive deeper into SJF's approach to impact management with their guest post on impactalpha.com. And thanks to our producer, Isaac Silk, and to the whole team at Impact Alpha, investment news for a sustainable edge. And to all of you agents of impact as well, thanks again for all that you do.